time is 4 p.m.
Hi, good afternoon, everyone. It's 4 p.m. Let's give it another minute before we start. Okay, I think we're good to go. So good afternoon, everyone, and welcome to Glide Invest monthly webinar series. We are really excited to continue this series of events for our viewers and customers across the globe. My name is Jaideep Tibrewala. I am the head of product here at Glide Invest, where we are building a guided investment app for retail investors across India. The agenda for our webinar today is crypto. So while crypto has been around for a while, I myself started playing around with first in about 2018, gambled with it a little bit. Then everything got locked and busted in 2019 due to regulation. And then again, things opened up, and this time it opened up with a bang. Today, it's a vast uncharted territory where there are a lot of people who are getting very deep into it. And then there are a lot of people who don't know anything about crypto, but want to do something in crypto or want to invest in crypto because they think there's a huge upside to it, right? But like any other financial asset, it's essential to understand what you are getting into before you align any serious investments which you think will be sustainable over a period of time. And that is the genesis of the webinar today. So we will start off with a short presentation on the basics of cryptocurrencies, followed by another perspective of crypto from a portfolio manager's view. I will then bring both the presenters into a panel discussion where I will take up some of the questions that our viewers can share with us. So please share some of the questions that you would like to ask on the YouTube channel. Okay. So let's get into this. Our first presenter today is Tushit Thakkar. Tushit is a quant analyst for PMs and AIF schemes at Motilal Oswal AMC. He is primarily responsible for research on factors and systematic quants at the firm. He has over 4 years of experience in capital markets, ranging from research to construction and management of varied investment strategies. Beyond his day-to-day job, which is related to traditional finance, he is quite passionate about decentralized finance, DeFi, and blockchain applications. From investing in cryptocurrencies and NFTs to participating in DAOs, Tushit loves to experiment and believes in the future of crypto assets and Web3. And for all those who didn't get a sense of some of the terms I use here, Tushit will be talking about them very soon. Tushit holds a master's in economics and a bachelor's degree in electronics and instrumentation from BITS Pilani. So Tushit, handing it over to you.
Thanks a lot, Jaideep, for that kind introduction. I'm sharing my presentation. I hope that's visible. Yeah. So good evening, everyone. I hope all of you are doing great. It's a pleasure to be here and talk about crypto. So over the next half an hour or so, my job is to give you a primer on crypto assets and what blockchain is. Right at the beginning, I'm going to declare that this is a difficult thing for me to do, as the topic is so diverse and there's so much stuff that is happening that it's impossible to cover everything in the given time frame. Correct? So what I will do is give an overview of what blockchain is, what are crypto assets, and then we'll go beyond the technical breakthroughs of blockchain. Correct? The best place to start understanding crypto and blockchain is, I think, with Bitcoin. Correct? And the best place to start talking about Bitcoin is the concept of decentralization. Correct? So if you look at traditional world, we have a centralized entity that has a record of values across participants, and we interact with it. Correct? Take the case of UPI. How does a transaction happen? I make a payment through the app. The National Payments Corporation of India, that is the NPCI, it acts as a switch between the app and the bank. NPCI sends the request to the bank debits the money on my behalf and sends a response back to the NPCI. It then sends a request to the receiver's bank and you get a credit response. Correct? So if you look at this entire flow, Almost all of the intermediaries here are centralized entities, correct? And these are not open systems. You need permission to use them, correct? So these are centralized and permission networks. So consider this strange fact about the modern life. Although much of our lives have migrated online, money still remains in an analog age, correct? So I'm not talking about from the our perspective, correct? Because for us, we have the slick fintech apps, we have the online bank accounts, correct? So we don't understand the reality. But the underlying plumbing of our modern financial system is very archaic, correct? So what we are looking for is something or allowing money or items of value to move in a way that text messages do between two people, correct? Without any central dependency or intermediary. And that requires an altogether different solution. So what you're looking for is the network on the right, correct? This is how value transfers in a crypto world. Correct? That's a single distributed database of value, which is open to everyone. Anyone can access it, and it's entirely permissionless. Correct? So this is what we are looking for from a payment gateway type of system. But the problem here that lies is, how can a network trust the other members and ensure that the communication is valid? And how do you reach consensus among all of these group members or networks when the system in itself is decentralized? Correct? And this is the heart of the problem. Correct? How do you trust a system, or how do you trust people in the system where we don't know each other? Correct? And this is what Satoshi Nakamoto tried to solve and came up with this paper that he published, Bitcoin, correct? The Bitcoin white paper, where he provided a very general solution to this problem by the use of blockchain, correct? So that is what we are going to talk about, blockchain in that sense. So what he did was he laid out the entire backbone of all the crypto assets that had today. And what he proposed was very simple, correct? He proposed a ledger to bookkeep these messages, payments, transactions, whatever be it, remove the element of trust within this decentralized network and instead replace it with cryptography. And this is the beginning or the genesis of Bitcoin. Correct? So let's understand Bitcoin. Correct? It's a distributed ledger system. As I said, everyone owns the ledger. Correct? It's open. Everyone knows what transactions are being recorded. It is permissionless. No one needs permission, correct, to view this ledger or to get access to the system. It's maintained on a decentralized basis. Correct? So there is no central authority which has possession over this entire network. Correct? Each and every constituent of the network holds that entire ledger. So that is, in essence, the idea of Bitcoin. Correct? How does a transaction happen? It's very simple. Here is a network. Just as an example, here is a network. There are a few people, people that are there in this network. Suppose A proposes a new transaction to a network. Correct? He wants to send money to B. So transaction is proposed. Correct? There are these miners that are out there. Correct? What they will do is they will look for all of these transactions which we are being proposed and combine them into a block of all transactions. And they will do some puzzle solving, cryptographic work. Correct, in order to validate this, or in order to introduce this block of transactions into the ledger. Correct. Say, for example, C solves that puzzle and comes up with a new block. What will happen is that all the participants in the network will validate that block and accept that block into their entire ledger system. And this is where the word blockchain comes from. Correct. The ledger is nothing but a series of blocks, each containing a group of transactions that are chained together. Correct. And they are chained in such a way that these are immutable, in the sense that you cannot go back in history and reverse these transactions. So in order to keep a good flow of record keeping that is there. So this is basically the basic understanding of how a blockchain or a Bitcoin type of structure works. Correct? So we have understood Bitcoin, but then why does more than one crypto asset exist? Correct. If you talked about Bitcoin, then why do crypto assets like Ethereum, crypto assets like Polygon, Matic, or Solana type of crypto assets exist? Correct. And the answer is very simple. It's that the underlying blockchains are optimized for different use cases. Correct. So if we borrow an analogy, a mutual fund and an ETF, both are investment vehicles, but both are optimized for very different use cases. Correct? And the best way to understand this would be to look at the Ethereum blockchain. Correct. So Bitcoin is a decentralized open source blockchain based person to person P2P payments type of platform. Correct? Ethereum, in contrast, is a decentralized open source blockchain based computing platform. Correct? In fact, the developers of Ethereum designed it to be Turing complete. What does that mean? It means that it can be programmed to do anything that a general computer can. So in a way, Ethereum is nothing but a network of decentralized computer system, correct? A decentralized computer. If you look at the Ethereum stack, correct, there's lots of layers in the stack. So there's the basic Ethereum blockchain on which there are these assets, and assets can be anything. It can be a currency, it can be different assets, it can be a non-fungible token. We'll talk about these things as well. Correct? On top of these assets are applications that use these assets. Correct? Applications are nothing but smart programs or apps that we normally use in our day-to-day life. And then there is an aggregation layer which uses all of these apps together. Correct? So in essence, just like Bitcoin was we could use or understand Bitcoin through a centralized to decentralized type of system of payments. Here you can understand through an app store kind of structure. Correct? So while the traditional apps that we have all have a common central entity, they have a data center, correct, from where we source all of the information. What Ethereum is trying to build is a decentralized app store, correct? Each and every participant at the end of the day is a network in that entire chain. That's the idea of Ethereum blockchain, correct? And one might assume basically that the additional flexibility would basically make Ethereum a better blockchain than Bitcoin, but this functionality comes at a cost, correct? So in practice, the simpler a blockchain is, the more secure its technology is. Correct? So the simplicity of Bitcoin makes it very extremely secure, and this gives people the confidence to transfer large sums of money into the system. Correct? So this serves as the property of digital gold that we talk about. While on the other hand, if you look at it, Ethereum offers the flexibility or the ability to program any type of transaction. So correct. So this comes with a technical risk that is there. But while this becomes unacceptable for people or for Bitcoin users, it allows for very interesting applications that can be built. So as you can see, these are very separate use cases. And there is this trade-off, correct? That we have a trade-off between security. We can aim for highest level of security, but then we give up on this programmability feature or the speed feature. Right? And we can instead go towards or optimize for programmability, but we may give up on speed. So these are the three biggest trade-offs: security, programmability, and speed. This coupled with other points of difference, such as focus on governance, how private is it, or the privacy of the coins, etc., leads to very different use cases. Right? So here you can see different type of crypto assets. There's Bitcoin, there's Ethereum, correct? We talked about these two. Then there's something called Monero, which is a privacy coin, which is more focused on giving users privacy. Then there is something called Tether, which gives you this entire feature that Ethereum type of structure gives, but its value is pegged to the US dollar. Correct? But then the trade-off here is that it comes from a centralized agency. So you give up a lot of the decentralization features that are out there. Then there is Chainlink. Correct? Chainlink is nothing but it's an Oracle type of structure. So it basically is a third-party service that connects this entire blockchain world with the outside world, correct, to transfer information across both the worlds. There is decentralized exchanges like Uniswap. If I have an asset, I want to transfer it to another asset, I can go through a decentralized exchange and transfer those, correct? There are layer 2 solutions, correct? So these are basically something like Polygon, for example. It's a layer 2 solution. What does layer 2 mean? It is built on top of this existing blockchain, but what it tries to do is solve the transaction speeds and scaling difficulties that are there in the primary network. And then finally, there are some social tokens. So the last token that here you can see is the token called Friends with Benefits. Right? So it's a group of cultural creators who are using Web3 tools to build a community and foster creation. And this token basically acts like a gateway to that particular community. Correct. So as you can clearly see, there are different types of crypto assets that are available. Just like if you borrow the real world, there are different types of social networks that are available. Correct? And all social networks have its own individuality. Facebook is used for social connections. LinkedIn is used for work. WhatsApp is used for chatting. Correct? Similarly, there's something similar which is going on or emerging in the crypto space. Correct? So now that we have talked about what blockchain is and these crypto assets are there on top of these blockchains, let's look beyond the technical breakthrough of blockchain, correct, and see how does it impact the real world. Correct? And again, answering this question is not going to be easy. Attempting to do so is basically trying to guess that how in the early 1990s internet changed the world. Correct? So clearly, internet represented new ways to distribute information. It had major consequences and breakthroughs here. But moving from that and trying to predict that at some point in time in future, people would be able to hire cabs, they would be able to order groceries or rent out a stranger's house. Right? This is a whole different matter. Correct? And this is one of the primary reasons why people compare this to the internet eras, along with the fact that both of these technologies have had a similar adoption curve. Okay. So in similar lines, blockchain represents a whole new way for us to transfer valuable assets and money. Correct? So moving from that particular aspect to giving a precise prediction of future applications is going to look very difficult. So what I'm going to do here is focus on three broad areas where most of the impact is being seen at the moment. Correct? And the first is simple. Correct? This is something that everyone talks about. It's the rapid, low-cost, 24/7 settlement system. So consider this transaction. On the 12th of April, 2020, someone transferred a Bitcoin almost worth of tune to $1.1 billion at a single time in a single transaction. Right? The transaction was settled in 10 minutes, and the fee for processing this entire transaction was $0.68 or 68 cents. Contrast that with international money wiring, which can be sent only during the banking hours first, takes 1 or 2 days to settle, and has fees that range from 1% to 8%. Right? So talk about this efficiency. An unmanaged software network with 0 employees settles $1 billion plus transaction in minutes, whereas the largest banks in the world will take it multiple days and plus $5,000 on top of it to move abroad. Correct? In addition, transactions can be sent at any given day or time and from any location to any place in the world. Correct? This is the efficiency that is talked about in this capability. Correct? And this efficiency basically does not mean that we are going to tomorrow start buying coffee with our crypto anytime soon. All it means is that there are transactions which are of high value, or there are transactions which required faster settlement speeds, required less fees, they need high transparency. And here you will see a material improvement. Correct? Take this as an example. There are bonds that now are being issued on top of the public blockchain. Correct? So not only it becomes very easy for settlement to happen, but it also acts, the registry is very simple, the record ownership is very simple, it's all transparent. Correct? So this is an area which becomes very interesting to watch going forward, which is the second capability. Correct? And this is the creation of scarcity and property rights in the digital world. Correct? So the biggest breakthrough that crypto asset powered blockchains has basically given or facilitated is the concept of digital scarcity and digital property rights. Correct? So we talk about this, there are only 21 million Bitcoins that are there in the system. Correct? So it's a type of digital scarcity. So if you look at history, historically, the only way to own something online, correct, has been to have your ownership recorded by another third party in a proprietary database. Correct. So for example, you own stocks. Correct. If you own something stocks, and these are in the demat format, correct, your broker keeps track of what stocks you are owning. Your bank will probably keep stocks of what balances you own. If you're someone who's a gamer, then video game companies will keep track of your in-game purchases. Clerks or offices will basically keep track of the land. Registry will keep track of the land titles that you own, and so on. Right? Crypto system basically flips this system. Right? What it does is, because of this underlying blockchain, the database that is available to everyone, without being controlled by a single entity, these assets can basically provide guarantees of ownership that was previously very impossible to do. Correct? So in fact, if you look at from an ownership point of view, blockchains offer the most strongest type of security, even more strong compared to the physical world. Okay? And the most often infamous example talked about here is the concept of NFTs. This, so what are basically NFTs? NFTs is nothing but a non-fungible token. So these are nothing but tokens or assets that we transfer in real world, in the crypto world, but except it is not fungible. Fungible in the sense is that, say, for example, if Pratik owns 1 Bitcoin and I own 1 Bitcoin, correct? There's no difference here, correct? In the fact that the Bitcoin that he owns and I own is pretty similar. If we exchange those Bitcoins, at the end of the day, we are still the same, correct? To borrow a real life analogy, what I can talk about is a piece of paper. So if you have an A4 size piece of paper, which is blank, right? If I own a paper and you own the paper, both of these, if we exchange the paper, it's there's no value being transferred here. Correct. So in this sense, these are fungible tokens. But if I write, and suppose I have $1 million idea and write that down on the piece of paper, that piece of paper suddenly becomes much more important to me. It becomes different from the piece of paper that you are holding. Correct? And this is nothing but non-fungibility. Correct. So if I own a token with a particular type of JPEG image on it, it becomes my digital property. And I can do this similarly with blog posts. I can do it with music. I can do it with videos. And this basically is where most of the creative destruction is happening. Correct? And this becomes the underlying structure and infrastructure for what we call the Web3 world or the metaverse world. So this is the second breakthrough. In the Web1 world, correct? The only way we could interact with the internet was to read stuff, correct? And it was static text, entirely decentralized, correct? And then slowly and steadily over the couple of years and decades, we moved into the Web2 structure, correct? Where we could read and we could write, correct? But whatever we write, correct, we don't own it, correct? The platforms own it, correct? And infrastructure is powered by cloud, mobile, but it's centralized. What Web3 is trying to do is create a new paradigm, which is the read, write, and own type of interact, where you could own digital assets. You can own blog pages, you can own blog posts, you can own any piece of creative thing that is there on the internet. So, for example, talk about music NFTs. So today I can own a piece of music and collect royalties on top of it. So these are some of the interesting applications of paradigms that are happening currently at the moment. Just a side note here. So a lot of people, when we talk about NFTs, think about these Bored Ape NFTs or wash trading or $1 million of asset, $1 million of rupees or dollars being spent to buy stupid JPEGs, correct? But what is interesting about this idea of NFTs is the possibility of linking something non-fungible thing in the real world, correct? So say, for example, you will be able to digitize ownership of houses. You'll be able to digitize ownership of factories, the contents of a shipping container and stuff like that. So imagine one day, if instead of getting your title to your house through some archaic registry, right, where you have to go to the court, you have to look through various documents, you have to figure out if there is any lien on the house or not, it will all be on the blockchain, fully transparent, correct? And home sales will be easy. You would be able to do it in a fraction of a second. You will be able to own a fraction of the house and also get mortgage on that instantly as well. Correct? So this is the capability that can be provided through this concept. And finally, there is the third capability, which is digital smart contracts or the concept of programmable money. Correct? This is basically the world of DeFi or decentralized finance that we talk about. Correct? And according to me, makes perhaps is the most exciting impact of blockchain. Basically allows users to effectively program money with certain rules and conditions as you could program any particular piece of software. Correct? So with money being programmable, you could have transactions such as Tushit transfers cryptocurrency X to Pratik, but only after Jaideep agrees. Correct? This is something like how an escrow account works. You could have a program which says Tushit will transfer crypto asset X to Pratik, but only after a certain amount of time has passed, which is nothing how a trust works in real life. And you could have something like Tushit sends crypto asset X to Pratik only after Jaideep wins a race, like something like that. Or if instead, if Jaideep loses, then Pratik will pay cryptocurrency Y2 or crypto asset Y to Tushit. This is nothing but a contract. Correct? So blockchain allow these and many different types of complex transactions to be executed without the need of intermediaries. And in doing so, they aim to basically replace the core functions that are provided today by banks, lawyers, accountants, escrow agents, notaries, correct? In a way that is cheaper, it's faster, it's more transparent, it's open to all participants, and it's available 24/7, 365 days. Correct? And this, I think, is the biggest victory of crypto assets. So just to take an example, take month of May in 2021, most crypto assets corrected by 20% in a single day. Right? The losses kept on accumulating over the days. Drawdowns range higher than 40%. During this time, customers were obviously complaining about the market losses, but no one was complaining that the decentralized protocols failed them at a critical point in time. Correct? There were, I think, as per some data, there were more than 800,000 traders who bought cryptos on margin, on leverage, and there, I think, more than tuned to $9 billion worth of positions that were liquidated over a period of couple of days, all using smart contracts. Correct? But all of these sites ran without any incident, ran without any downtime. No protocol failed, needed a bailout, and no regulator had to close down something. Correct? As you can see in this chart, correct, there are more than $200 billion worth of assets that are currently locked in on these smart contracts, which power basically these DeFi applications, be it lending, be it exchanges, be it insurance, asset management, all of the uses that are there in the traditional finance systems. Another interesting feature about the digital money is the type of central digital currencies, correct? CBDCs. So take, for example, the example of the CBDC or a central currency that China is currently bringing, correct? The digital yuan. It is programmable in such a way that, say, for example, during times of crisis like the COVID crisis, the government could increase its money supply, and that money will come in such a way that the money is programmed to have an expiry date. So for today, if for example, central governments pump money into the system, that money, in fact, what happens is a lot of people start saving that money instead of spending, which does not lead to the increase of growth in the economy. So what can happen is, here with this expiry date, you are forced to spend money into the system. And this basically flips how we are talking about monetary theories, theories and fiscal problems in a completely different way. Right? So this is a very interesting area to watch in the given future as well. These are the three, according to me, important paradigms where a lot of disruption is happening, a lot of creativity is being put down. Coming to from the benefits to some of the warnings, correct, is that a lot of people come into the system with an expectation of making returns, thinking that past returns will be equal to future returns, but that is not going to be the case. Correct? So if you look at it, if you're coming from a view or coming from a perspective of investing, where you think that past returns is what going to drive, and I'm going to make this incredible generational wealth in a given one shot, that is something which will come at a very big warning. The second point is that the systems that are there here are very highly volatile. Correct? There's in some of the large portion of the assets, there are lots of market manipulation that is being done, and even in the the top assets that are there, correct, like good coins like Ethereum, Solana, Bitcoin, there's lots of leverage in the system. Correct? So even if you are investing, you will see massive cyclicalities that are there. The third important point is that a lot of people think this is an inflation hedge or a macroeconomic tool. Correct? It's not. If you look at the previous couple of years or so, Bitcoin behaves like a very high beta type of asset. It goes up with the overall stock market, comes down with the stock market, correct? And despite inflation going up, it often corrects as well. So if you're looking for something that this is an inflation type of hedge, then this is a warning. The third point is custody, correct? So if you own Bitcoin or if you own crypto assets on a centralized exchange, these are actually crypto assets that are not owned by you, but instead owned by exchange. So someday going forward, probably the exchanges could be hacked. There could be any thing that happen. Say, for example, take the example of what is happening in Russia, Ukraine, correct? Where countries are weaponizing financial systems against each other. So this can happen. And if you don't own your Bitcoin in your own personal wallet, then you don't basically have custody of it. Correct? So that's an important aspect. There's high taxation, I think everyone knows, and there's uncertain regulation that is there. Correct? So these are some of the warnings that are there. As far as recommendations is concerned, from my perspective, so although Pratik will cover from an investing perspective, I come from a perspective where I would say that I would recommend everyone, if not thinking from an investing perspective, but to start experimenting with the system. Correct? These are very interesting systems that are there. Think of these asset classes as digital commodities. Correct? So if you're someone who's looking for cash flows, if you're looking for dividend deals, something, these are not this type of assets. Don't compare them with any other asset class. Correct? It's a different asset class in itself. it comes, it's, as I said, it's like a digital commodity, correct? You can, just like you can, there are no cash flows to aluminum, correct? But you can use aluminum in ways, correct? You can basically build on top of it, and it has its own supply and demand curve. Most of the digital assets work in similar fashion, correct? So they have their own supply demand curves. They have some leverage, etc., going on, but you can build applications on top of it, and you can use these assets, use these crypto assets to build something, correct? So that's the overall idea. Use exchanges that are more safe in nature, correct? From a recommendation perspective, if possible, store your crypto in a wallet. If anyone is interested, I can also talk about how wallets are there. If you're investing from a portfolio perspective, commit for a long-term perspective, correct? So what will happen is it will reduce your taxation impact. So look from that perspective. And from I think Pratik will already cover the allocation prospect of it, but make sure that there's significant impact of volatility and drawdowns that are there. So be cautious of that particular aspect. So I think that's it from my side. So very simple, basic primer that I had to give. I hope that this was somehow give you an overall overview or perspective. There are so many things that we could in fact cover in even more detail, correct? Of what are the even separate use cases, or even in these 3 capabilities that I talk about, we could go even more detail, but that would become even more technical. So we could do it at some other point in time. Thank you from my side. Thanks, Jaideep.
All right, Tushit, thank you. That was very interesting. Let me make a list here. Bitcoin, Ethereum, blockchain, decentralized exchange, Web3, NFT, Metaverse, Solana, Polygon, DeFi. Those are only some of the terms that you introduced out here. Thank you very much for the simple examples that you used. I hope a lot of the viewers could associate with those examples and get some sense out of this. But as you said, people need to be careful about what they're investing in, understand what they're investing in. And to take this one step further, let's bring on our next presenter, Pratik. So Pratik Oswal currently heads Motilal Oswal's AMC passive fund business, as well as their fintech business, which is Glide Invest. Prior to this, he was heading operations and finance at a Series A fintech startup in San Francisco, California. The company was backed by prominent investors such as YC, Khosla Ventures, Anthemis, Chicago Board of Exchange, and many others, and provided automated wealth solutions to investment advisors and managed over $400 million in assets. So apart from fintech, Pratik has experience working in investment banking, private equity, and hedge funds. He studied math and economics at Emory University in the US and has an MBA from the London Business School. He's a big believer in the power of compounding as well as the India growth story. So Pratik, handing this over to you to give us a different perspective on looking at crypto from a portfolio management perspective.
Hi, thanks Jaideep, thanks Tushit. That was a great presentation on the basics of crypto. Good evening, everyone. Looking forward to having a great discussion with all of you. My topic is going to be slightly different. It's going to be talking about crypto as an investment asset class. I think there's a lot of interest in cryptocurrency, and most of the interest, I would say 90% of it, would be towards crypto as a investing destination. I think a lot of people want to invest in crypto because of the potential upside that you can have, based on what has happened in the past. So I'm going to go do a little bit of a deep dive, not on the applications of what it is, but actually, how should investors or potential investors, or what are some of the things that you should keep in mind, when you're looking at such a different asset class. This thing didn't exist, I would say maybe 10 years ago, and now like a lot of people have I think adopted this, especially in India, where you're having record number of transactions and number of investors who are investing in it. So that's basically my topic. Let's start off with the basics. I think Tushit talked about the fact that there are several applications of blockchain technology, and one of them is cryptocurrency. The other one is DeFi, and I think the third one is I think the Web3 or ownership. But one application that people don't really talk about in public is the fact, and this is the most common application, is at least what has panned out in the last decade is wealth creation. So can you use cryptocurrency to create wealth? Is it actually a currency? What has happened? I mean, it is sort of structured like a currency, but how should investors see it as of what has happened in the last few years? But let's start off with something very basic. Why is it tough to ignore cryptocurrency? Why are people finding it very difficult to avoid it in India and in sort of other places around the world? Why is it difficult for someone to ignore or just keep it aside? It's because of the sheer wealth, or at least the price appreciation of crypto since the start of the decade or last decade, which is 2010. It was available under $1, and today I think it's trading at, I don't know, maybe $40,000-$50,000. So the sheer magnitude of prices of Bitcoin and other cryptocurrencies like Ethereum and others have gone up in a very big way. And this appreciation has also led to more interest in this currency. Unlike, say, an e-commerce website, where the higher the discount, higher the demand. When it comes to investment products, the higher the price, the higher the demand. So as the price keeps on going up and up, demand will also always increase. This not only works for stocks but also works for cryptocurrencies. So as long as the prices are maintained or going higher every day, you will see more and more demand for this sort of an asset class, which I think is very interesting because I think people. No one would have sort of really been interested in cryptocurrency about 10 years ago. But I think one main factor to why it's got so much adoption is little to do with, I think, the applications of cryptocurrency, about the fact that it can really be a good form of currency. People can go against the governments or beyond the governments. People can structure these contracts in a very sort of low cost ways. But actually, it's been the price appreciation, and I think even today, as I said before, most investors tend to be talking about cryptocurrency. No one says that have you bought US dollar or the Russian ruble or the pound. I think that would be you would only buy it if you were traveling to that country. But when people say have you bought Bitcoin or have you bought Ethereum, I think people say it because they want to ask you if you're invested in it. So I think the number one use case so far has been investment. But what is the issues? I mean, this chart is pretty nice. It's pretty much a straight line. But most people have not, over the last 10 years, have not really seen the sort of drawdowns that crypto as an asset class has. So even though it's done really well, across the long term, which is last 11, 12 years, in periods, crypto can be a pretty painful experience, for a lot of investors today because of the huge drawdowns that you can see in crypto. So this is the early years in crypto, so 2013 to 2016. Where not a lot of people knew about crypto back then, but someone who had invested in, say, 2013, had to wait about maybe 4 or 5 years for them to get the money back. So, which is a very long time period. So, I think it's not only is it a very volatile asset class, but also it's an asset class where investors need to be extremely long-term oriented and need to expect many drawdowns or many short-term sort of I think pullbacks which keep happening. So this is one example of it over a very long time. But even if you see this from a very short-term perspective, say 6 months or 8 months, you'll see sort of similar graphs where people have I think seen huge drawdowns. This is a later year. This is when crypto became slightly popular. I remember in 2017, when I was in the US, there was a huge craze for cryptocurrency in 2017. Prices have gone up in a very big way. A lot of investors came in at about end of 2017, and this includes me. I had a small investment in cryptocurrency in 2017, but I had to wait about 4 to 5 years just to break even to what my investment value was. So I think steep and long corrections is something which investors need to know about. And if you are looking at a short-term trade, then this is not an investment. When you're looking at investing is ideally a process where you put your money down for 4, 5, 10, 15, 20 years. And if you're looking at crypto as an investing, not as somewhere where you want to make a quick buck, then you have to give it that much time, and you have to be okay with having periods of 4, 5, 6 years where you will basically have those deep drawdowns until you start making money. This is also the past. There's very little to say about how it will pan in the future, but at least the past has taught us that, it's a pretty, it's an asset class where you really need to have a lot of patience. In addition to that, it also has high volatility, which I'll talk about later on. So, this is just a summary of use cases. I think Tushit, again, did a great job of talking about some of the use cases of cryptocurrency, especially blockchain. Essentially, I think cryptocurrency is a use case of blockchain technology, which is decentralized, which requires you to have a distributed network, which sort of talks to each other and validates transactions. But again, just to keep it very short, there's, at least as of today, there's 3 use cases of cryptocurrency. And and if you look at any presentation, no one will talk about wealth creation. People will talk about use cases. People talk about, the money revolution, which I talked about, where you can really settle transactions at almost no cost and very little, very, very quickly. Then you have DeFi, or decentralized finance, where banks will be sort of won't be able to compete with like a network where you don't need employees. You can do an IPO, or you can manage mutual funds on the blockchain, which is a lot cheaper than going through like a mutual fund and a trust and brokers and the entire sort of intermediaries. So it's much easier way of getting access to finance. Today, a lot of loans are available on these platforms, which make it a lot easier than you becoming a bank and issuing loans. So again, a lot of applications in finance. And lastly, as he said, it's about it's about ownership. I think a lot of people are using crypto to build up their ownership in digital. So far we haven't seen any applications on physical assets, but we have seen good applications in digital. But what's funny is that these 3 applications are valid, and there has been growth in each of them. But the biggest, I would say, use case, at least today, is of wealth creation. I would say most people who are interested in crypto are looking at it from an investment lens. And let's look at that. We looked at a little bit about why it should be looked at investment lens. At least a lot of people who are into it are looking at it. But the reason why I think it's important is because of this term called correlation. So let me just explain what correlation means. When you're looking at evaluating an investment product, or a stock, or a mutual fund, or I think like a private equity, the number one question that people normally ask is, what are the returns? Actually, the biggest question that you should ask is, what is the correlation? Correlation is the most underutilized and most powerful financial jargon that investors should be asking. It's about, and the reason why this is so is because if you have, say, 5 or 6 investment products in your portfolio, and all of them have a high correlation, say 90% plus, then people feel that because I have 5, I am diversified. But that's actually not true, because what we've seen is that these 5 assets tend to move together. And when you move together, you have zero diversification. So if one goes down, all goes down. So for example, if today you hold a mid-cap fund, or a large cap fund, or a small cap fund, sorry to say, but that is little diversification in your portfolio. When a mid-cap fund falls by 30-40%, all your funds will be falling by 30-40%. So there is not a lot of diversification when you're investing in equity, which is why a good way to invest in or make your investments is to buy low correlated asset classes. It's called asset allocation, where you buy some equity, you buy some debt, you buy some gold, you buy some international equity. And obviously you could also look at crypto as an asset class. And the reason why you look at different asset classes is because they tend to balance out each other. So this is a slightly complicated slide, but as you can see, the blue line is cryptocurrency, the red is, say, S&P 500, which is a US index, and the green one is gold. And as you can see, all 3 are pretty different from each other. Obviously, crypto is a lot more volatile. That's the one thing that stands out. But when, for example, S&P did badly out here, your crypto did well. When crypto did badly here, then gold did really well. So I think the reason why most of the proponents of cryptocurrency, are talking about diversification, which may not be the right argument. But the point here is that crypto has absolutely no correlation with anything out there. So it has no correlation with equity, no correlation with debt. So as you can see, 10%, 9%, 7% is basically close to zero correlation. So what that means is that not only do you have an asset class which is done really well in terms of returns, you also has something which does not go with any other asset class. So if you allocate your money to this, not only will you see a more diversified portfolio, but you also may see a higher returns also. So this is very important. So whenever you're evaluating like investment product, always think about correlation, and crypto is very low correlation, which is why it is by definition good for portfolio management. But let's look at that a little bit in detail. So one is obviously, once you've decided that you obviously want to invest in crypto, what is a good price for crypto? How are cryptocurrencies different from stocks? What are some of the risks that comes in crypto? And is crypto a currency? That's the most important bit. Are you investing in a currency, or are you investing in an investment product? And we'll obviously talk about this in slight detail. But what is a good price for crypto? That's a fundamental question. Is 60,000 a good price? Is 40,000 a good price? Is 100,000 a good price? So is it a bubble? Is cryptocurrency a bubble, and will it pop in a few years' time? Well, so by definition, a bubble is something which is valued beyond its true value. So something that is valued at say 50, but it's trading at say 200 or 300 or 1,000. Then that's basically like a asset class which is which is very expensive, or it's valued very high. And if it's very high, then you can call it a bubble, because what we've seen is that over the long term, things tend to keep to their original value. So if something is valued at say 100, even if it goes to 10,000, it'll come back to 100, because that's the true value. The thing with cryptocurrency is that there is no intrinsic value. There is no intrinsic value with cryptocurrency. You really don't know if the true value is $1, $10, or $1 billion. No one really knows. So because of that, having that argument is that this is a good price to play does not really make sense, because we don't know what's a good price and what's a bad price when it comes to cryptocurrency. So this is a very interesting sort of dialogue where price doesn't really matter. It's about whether you own it or not. I think that's really what matters. When it comes to stocks, the reason why stocks are wildly different from cryptocurrency is because stocks have a backing. You have a balance sheet or a profit and loss statement. So that if a company is say worth a 10,000 crore, you know that you can fall back on its financials. Ultimately it's backed by strong business models, strong financials, whereas you don't really have anything that's backing cryptocurrency. So very important, when people are comparing, it should not really be compared to as something as simple as a mutual fund or stocks, but it's an own asset class by itself. Gold, for example, would be the closest example for cryptocurrency. A lot of people invest in gold, and gold is actually a very wise investment, because again, it's physical. That's one thing, but also it tends to do really well, especially in bad markets, from what we've seen in the last 30-40 years. So I think it is so. As I said, even for gold, it's hard to say if something is a good price or a bad price. Gold is always appreciated in the last 40-50 years, and it's still hard to debate whether it's a good price or bad price. So very important, I think it may not be a currency so far, at least from what we know. When I did do some research on cryptocurrency in 2017, I was expecting myself in 5 years' time to go out there and travel to a different country and pay for coffee in say a Bitcoin or an Ethereum, but that has not happened, and I don't see that happening very soon either. So I think the usage of currency is something which we'll have to see how that works, but at least so far it's becoming an investment product, and I think that's where at least it is today as of now. So what about adding this to your portfolio? So this presentation today is about adding crypto to your portfolio, and how much of crypto should you add to your long-term portfolio? This is an excellent study. Again, it's biased because it's made by someone who's a proponent of cryptocurrency, but it's a very interesting study which says that the lightest green line is a 60-40 portfolio. A 60-40 portfolio is a portfolio that invests 60% in equity and 40% in debt. It's the most popular, most common portfolio that most people would have, at least today. And the idea was that, if you just put 1% of that 60-40, so if you're doing 60-40 and 1% holding of Bitcoin, or if you're doing 3% or 5%, you can see that the returns have gone up tremendously. You're looking at returns of about I think 20% has gone up all the way to 60% just by adding a small amount of Bitcoin into your portfolio. So, I think, from this, it looks quite rosy. I think that just investing a small amount of your portfolio can have a cascading impact into your returns. In fact, it makes a huge difference to your returns over the long term. But this is as of the past, and we obviously don't know what the future is going like. But this study confirms that at least as an asset allocation decision, if you say invest about 1% of your net worth, in crypto, then that can have a good impact on your overall portfolio. And this is quite special because no other asset class behaves like this. So for you to add gold to your portfolio, or you have to add, say, international stock to your portfolio, 1% is not going to make any difference to your portfolio. Portfolio returns will be exactly the same. But Bitcoin, because of its crazy growth in the last 10 years, just a 1% addition can make a cascading impact your portfolio. So very interesting based on obviously historical returns. We obviously don't know what the future will be look like. But the problem with this graph is that it shows you point-to-point analysis. What does that mean? That means that you have to start investing in 2013 and you have to invest till June 19. So basically, it's showing start to finish of about 6 to 7 years time. But what about in the middle? What happens in the middle of all of this? Suppose you decide to invest in 2013. What happens after that? What happens there is that you have to be super patient, extremely patient. This is basically a chart that talks about a lot of the drawdowns or short-term sort of falls in cryptocurrency in the last, I would say, maybe 9 years, 9 to 10 years time. And as you can see, there have been times where you've lost 80, close to 85 or more than almost 90% of your money in a very short amount of time. That's the amount of drawdown that investors need to look out for. So if you're investing, say, 1% of your net worth every month, so every year, if you're investing 1%, you have to be okay with losing 80 to 90%, which has happened many times, or in fact, thrice in the last 10 years, which is quite scary. So if you invest 100, your 100 becomes 10 and it goes back to 200. And we all know that returns are asymmetric. What does that mean? That means if Bitcoin falls by 90%, after the fall, your investment needs to go up 900% to just go back to the original investment value. So when the fall happens, you have to go up 2x or 3x or 4x of that, or just for you to break even. So very important, it's a very painful process of holding Bitcoin for a long time. The second reason to why, holding on to Bitcoin is hard is because holding on to Bitcoin is very difficult for long term. So what we've seen, at least what I've seen in sort of investment research, is the fact that it is a very difficult asset class to hold on to. Number one, because of painful drawdowns, and number two, because of the upsides. Suppose you invested something at 100, and that 100 becomes 1,000 in, I don't know, like a year's time. Very few people can hold on to the 1,000. Very few people can hold on to the 1,000 knowing that they've made 10x or 20x or 30x in a very short amount of time. So invariably, even if you try to invest 1% of your net worth in crypto, in a year's time, if you say doubled it or tripled it or 10x'd it, it's very hard for you to hold on to it. So you won't know anyone. I in fact don't know anyone, or I don't know anyone knows anyone who's invested crypto in 2013 and who has held on, because it's just so difficult to hold on to your gains. Which is why equity is great, because equity grows at 15-20%, which is much easier to hold on than it is for cryptocurrency if you're growing at 100%, 200%, 300%. So first, very hard to painful drawdowns, and two, the upsides are so strong that you'll find very difficult to hold on to those gains for too long. So that's basically crypto as an asset class. I'll just quickly summarize what I talked about this presentation, and then we can open it up for a Q&A round. But basically, very important that we have a lot of use cases for cryptocurrency. A lot of use cases. We have DeFi, we have Web3, we have money. But so far, I think what has really worked is the fact that crypto has appreciated a lot more. So it's at least 95% of the public out there invest in crypto to make money. Yes, the underlying theme is decentralization and screw the governments. We want to go on our own. But I think it's important to understand that if crypto has only grown at, say, if crypto only grew at 5% per year, then very few people will be interested in Web3 or or any of that. So I think what's driving the crypto economy is price appreciation, and I think and when you buy it, you have to hope that it at the fact that there has to be someone who has to buy it at a higher price, in at some future, which can be pretty nerve-wracking, at times. So very important, very high volatility. But at least so far, the volatility has been compensated by high returns. So, crypto has shown crazy times, but returns have compensated them going on. The second is that it's very hard to predict what's going to happen in the future. There are so many risks involved when it comes to cryptocurrency. And I think I keep telling people that if you had to invest in crypto, invest knowing that you may not need the money in the future. So, invest knowing that you'll be okay with you losing that money also. Because of how uncertain it is. When you lose 70%, 80% of your net worth of your investments, it's very hard to be sane and hold on to those. You just want to sell and get out. So very important, hard to predict. The problem is high drawdowns, as I said. Even in stock investing, you see that stock prices always go up, but traders, stock traders who buy and sell on a daily basis, very rarely make money. And cryptocurrency, it's more volatile, so I would not recommend anyone to trade crypto. It's a complete loss making thing. So very important, I think, don't trade. If you want to invest, take a 10-year view and be okay with you losing whatever capital you have. Again, there's a lot of uncertainty around regulation, taxation, and also, governments might ban it, all of that. So which makes it a little bit more uncertain as a class. And as I said, I think you should not look at more than 5%. 5% also is a lot of allocation, but make sure that you have an allocation and stick to it. 1 or 2% also is perfectly fine if you want to experiment. And good philosophy is, invest what you're okay to lose. And to be honest, most investors should probably not look at it as an asset class. Today in India, a lot of investors tend to be conservative, based on my experience. And conservative investors are honestly, okay to avoid this sort of currency. You can look at, say, as I said, a small allocation, but I think it's a avoidable asset class. I know it's difficult to sort of, I think avoid, or, people are always talking about it, but, very few of your friends, would have actually made a lot of money. There are just few small cases here and there. But very important is that if you want to do it, you do have to do it systematically by keeping it 1%. And if it goes above 1%, you sell it. If it goes under 1%, you buy it. Make sure that 1 or 2% threshold, whatever you decide, make sure you maintain that over the course of your investment experience. So that's pretty much my presentation today on crypto as an asset class. We can now open it up for a Q&A. Thank you.
Thanks, Pratik. Again, very interesting to hear your perspective on this. A couple of things that I took away. Investing in small amounts, I think that's what a lot of those who are really interested in dipping their hands in crypto should probably think of doing. And those small amounts could be 1 to 3%, but keep it at that limit. Volatility is really high with investing in crypto, so be careful about that. There's a certain investing philosophy that probably goes in with the investing in Bitcoin, and you need to think about what your own philosophy is and what your own risk tolerance is and risk appetite is. I really wonder what Morgan Housel, one of our speakers in one of our webinars in the past, would say about this. And from my own personal experience, right, I would say the best way to learn about investing is by losing money, right? So maybe try it out a little bit, see what you learn. It's still in a very nascent stage. There's a lot to learn from Bitcoin investing, and see how it works for you and how you're able to deal with it. Right. So let's open it up now to a couple of questions. So let me start with Tushit. Tushit, one of the things you spoke about in your talk was wallets. So let's start with that, right? So can you maybe name a few wallets which are user friendly and safe, or how do I know which wallet I should put my money in?
That's a very interesting. That's a very nice question, Jaydeep. And I think what happens with wallets is, so first of all, what is a wallet? A wallet is it's basically a software or a piece of code that lets you own your own money. So just like in the real world, you have your money in bank account, correct? But say, for example, tomorrow there's a run on the bank and you are not able to withdraw your deposits. So same things can happen here. You have money, say for example, in a centralized exchange, anyone that is probably allowing you to buy tokens here in India. Something could happen and you would not be able to access those tokens. Correct. So what happens in a wallet is that you can store that wallet in your own, store that tokens in your own wallet, just like you would store money in your own wallet. Correct. But there are two types of wallets. These are hot wallets and cold wallets. Hot wallet is nothing but a simple piece of software. So, and at the end of the day, all your assets are stored somewhere with a cryptographic key. Right? If you hold that key in a piece of computer, it's nothing but a hot wallet or a software wallet. And you can use applications like MetaMask, you can use applications like Rainbow, right, to access, to basically access all your tokens inside that wallet. But please be very careful of the key that is there to the wallet. Because if, say, for example, I own the key to your wallet, then I can easily access all your funds and transfer it to my account. Right? So that's the first important step. The second is if you have a sizable amount of crypto assets in your portfolio, then I would recommend you to have a cold wallet. Cold wallet is nothing but having those keys, key to your assets inside a safe pen drive. Correct? So it's like a pen drive or an air gap type of pen drive, which is available. So there are two that are fairly known. One is Ledger and the other one is Treasure. Correct? So these are nothing but cold wallets that are available. If you have a sizable amount, you could store those cryptocurrencies there, and it would give you, you can hold them in a decentralized way, and you will also have the security of holding those money in that fund. That's the idea.
Great. Pratik, over to you. What do you think cryptocurrencies will be, or do you think cryptocurrencies will be accepted by governments despite its anonymous nature? What do you think of the Indian government's take on this whole cryptocurrency? I know they have once again delayed the final regulation that they want to put around it, but your thoughts?
Yeah, so I think so let's talk about what crypto is trying to solve. I think when I think Satoshi obviously wrote that paper, the whole idea is that there was a lot of mistrust in the system, and the whole point about cryptocurrency is to sort of bring trust to money management by having a system which self-regulates as opposed to having a third party regulated. So I think a big theme around cryptocurrency is the fact that you don't have to go with governments. You can do stuff on your own. You can transact with some person living in some other country without having to go in through any sort of bureaucracy. So I think it's more to understand that I mean, whether or not the government approves it or doesn't, there will be trading happening, or there will be investing happening. Like, unless it's banned, obviously, then obviously it'll be very difficult, or if it's made like a criminal activity. But even that, I think drugs are also banned, but you still have a lot of activity when it comes to buying and selling of them. So I think yes. The government today, wants to use crypto as a way to at least, get some revenue out of it, in terms of taxes and transaction costs and all of that. So I think because of the interest levels are so high, I don't foresee them taking a drastic step, because that will only make things worse. Whereas, if they can accept it as some commodity where you can have people exchange it or transact or use it, while making it as a big sort of revenue factor, that can be a good way forward. The brokerage industry, the stockbroking industry, to be honest, has most of the cost that a trader incurs, goes to the government as taxes today, which is in thousands and thousands of crores. And that's become a big revenue factor for the government. So this could also be that. So I think in that sense, I think it's I don't expect anything drastic to happen, but yes, I don't think it's going to be a regulated asset class anytime soon because of the inherent risks associated with it. Also, I think it also poses a different risk in terms of a macro risk, the currency stability and all of that, which could come into place if there is a lot of sort of, I think, acceptance of this form of investment or currency.
Another question, just follow-up question for you, Pratik, on that. I mean, I know crypto is only, about 10, 15 years, probably less than 15 years old. But do you think, it can help create generational wealth, right? Or is this something that family houses or family offices should be even considering while building an asset base for their investors?
Yeah. So, I think a lot of the interest in crypto came in from retail investors like you and me in the first 5 to 10 years, in first 10 years at least. And now you're seeing a lot of institutional investors, family offices. I think the biggest asset class today for the real wealthy is actually not equity or debt. It's actually alternative cattle, or like a category called alternatives, which is private equity, cryptocurrency, art. I think collectibles. So I do think that there's a lot of interest happening in stuff outside your traditional products like equity, which is where I don't know if it can be generation wealth, but there is a lot of interest coming in. There are ETFs in the US that track the price of Bitcoin and Ethereum. There are Coinbase, which is the world's largest crypto exchange, has set up a separate business only catering to institutional clients, and they're seeing a huge response from them. And I think also there are a lot of funds which would probably come into place in the next maybe 2 or 3 years time, which will be tracking this. So yes, there is a lot of interest coming in from all sorts, but a lot of it is to do with the price of Bitcoin and Ethereum and these popular currencies. So if the prices go up, then you could see a linear demand. But if there is a plateauing there, or if I think interest comes because of yield, and if yield is not there, then you may not have interest in the future, which is good because then people can focus on it as a use case, as opposed to it being a wealth creation object. Even the applications, like simple applications like buying NFTs, you're seeing a lot of celebrities, buying these things. I think there is some amount of, I think social sort of, you want to feel good about buying these things. It's giving you, I mean, more than making money. I think it's you have this sort of exclusive club that people like to be a part of. So that's again there, but again, that's again a very wealth creation, social status sort of a thing. But yes, I mean, as I said, as long as there is a steady, I think increase in prices over the long term, this could be a generational wealth. But I think for someone to commit 5% or 10% or 20% of their money is still far away because of how volatile it is.
So yeah, talking about other investments, including crypto, I think one type of investment which would be very much against this whole thing are those environmentalists who strongly believe that and who claim that cryptocurrencies are not energy efficient at all. So Tushar, can you maybe comment on that a bit?
Yeah, sure. So
how does that work? How does crypto generating crypto use up energy? How does that whole thing
correct
work?
So if we refer to the initial part of my presentation, right, where I said that how do you reach consensus in a decentralized network, right, where there are different participants? And so here what happens in a Bitcoin, say for example the Bitcoin blockchain, is that there are miners, correct, who basically mine these blocks or couple these all transactions into a block, add it to the chain, maintain the networks basically. Correct. So for this maintenance of network, or to reach consensus within this network, there are two ways how we can do it. These are often talked about in the media and elsewhere as well, which is called the proof of work and the proof of stake. Correct. So proof of work is nothing where, but these miners will have to do some cryptographic puzzle solving in order to process that block into the blockchain, and then validators can validate that block. While in proof of stake, basically people who own money or who hold a lot of amount of those assets will stake their reputation into that particular network, and that will act as a self-servicing mechanism to achieve consensus. Correct. If you want a proof of work type of network, then yes, these are not going to be high energy efficient. Correct. So, for example, Bitcoin works on a proof of work type of structure. Miners are going to use or need incredible amounts of energy and power in order to keep on processing those blocks again and again. So this will be this will not be energy efficient at all. Correct? But to look at it from another perspective is that you could compare the amount of energy that is being used with, say, for example, different countries or these statistics that are already being put there. But you can also compare it with the already existing banking systems that we use, and they process significant amount of energy, correct, and computational power. So if you are willing to use Bitcoin as an experiment, and if you're willing to use it and say that tomorrow going forward, these are going to be a significant portion of our economy, then yes, then the entire puzzle becomes quite difficult to understand. On the other hand, a lot of these new age cryptocurrencies are mostly, or crypto assets are mostly working on a proof of stake concept, which don't use energy at all. Correct. So for example, the reason why Solana or some other currency has come into a lot of talks is because Solana, in contrast to Ethereum, works on a proof of stake concept. In fact, the crypto asset that we talk about often, which is the Ethereum network, correct, which has this countless number of computing potentials, correct. It is also moving over the next couple of months. It is moving from a proof of stake type of consensus mechanism to a proof of stake type of from proof of work to proof of stake. Correct. So when this type of transitions will happen, the energy in itself equation will keep on getting solved. But when you do that, you will give some amount of decentralization that is there in the network. So if you want a pure decentralized network, they will not be energy efficient. So that is something that we'll have to work our way. That will be a trade-off.
Interesting. So Pratik, a question to you. At Glide, we often talk about goal creation, right? And we, use a lot of asset allocation and goal creation also. And we, typically we ask the customers to either define a short-term goal, a medium-term goal, or a long-term goal. So what type of goal do you think crypto is ideal for? I would say definitely not for a short-term goal, but I'll leave it up to you. What are your thoughts on this?
Yeah, to be honest, I wouldn't keep crypto in short term, medium term, or long term. I think if you're doing goal-based investing, you have to be pretty certain that you will get your goal, and and when you're sort of planning for, say, crypto as an asset class, then you have to be sure that the past returns have really managed to happen in the future, right? So suppose when we are planning a goal which will end in 2000, like this 22, say 35, which is say 13 years from now, the only reason why we at Glide are able to predict the certainty of that happening is by looking at, say, last 10-15 years performance. And if you look at crypto last 10-15 years performance, and we plan goals in that perspective, then our SIP falls, are pretty small. So I think predicting returns is something which is extremely difficult, almost impossible. Like a year or two before your goal expires, crypto might just crash by 90%, which will take another 5 years to get back. So I would not, put crypto as an asset class if you're doing any sort of goal-based investing. If you're investing just on the side, outside your long-term goals, then you can do it. But I would not recommend anyone to, if you have a goal in mind, say you're buying a house, you're to buy a car, or you're saving for retirement, then this may not be the right asset class, because for you to plan, you have to know how much to expect, right? And with this asset class, you really don't know how much to expect. It's too short term, and it's very volatile. And also maybe 5 or 10 years before your goal expires, you might have some event. So I think it makes sense as a investment outside your sort of long-term investments if you are investing for retirement or a house. And as I said, you should be investing in crypto if you want. With the money you're okay to lose. So I think that itself is, I think outside goal-based investing, where you obviously want to create a portfolio which will last that long. So that's what my view is on at least using crypto, as a way for your asset allocation for your goals. You can do it as a separate sort of small investment, but don't make it don't use it, to predict anything.
Okay. So as a young investor, what comes first? Investing in crypto, or setting up an emergency fund, right? I think, what's your view on that?
For a young investor, I would say, I think, it really depends on, what you want to do. I think if you have, it's important to have an emergency fund, because, anything can happen, you might have. So it's good to have some amount of your investments in a liquid fund or cash or a bank account, because, emergencies do happen. So I think make sure you have that. But make sure that you that same money that you're sort of keeping cash. So you're talking about two completely different asset classes. One is the safest one out there, probably safer than a bank account also, and you're talking about an asset class which is the riskiest of all, where you don't know where your money is going to go. So I think for a young investor, I think if you're looking to save money for any emergencies, then yes, you should I think everyone should have some money in the bank account for emergencies. But obviously, if you have some money on the side, and if you already have your overall portfolio then you can look at maybe 1% or 2% of that in crypto. But it's perfect. I think if you avoid it also, it's perfectly fine. In fact, you'll sleep much better.
Let me take some viewer questions. So Devanshi had a viewer called Devanshi has asked. So I'm new to Bitcoin and crypto. There's so much information out there. Where do I start? So Tushit, maybe if you can take that. Couple of recommendations on where to start or how to start. That would be great.
Yeah, definitely. So if you want to understand the crypto and the blockchain space, I think there's a very interesting video as well on YouTube by a channel called 3 Blue 1 Brown, which basically explains how Bitcoin works, right? And as far as getting into deep in, say, for example, how does this entire crypto network work? How there are these different concepts that are out there, decentralized finance, etc. There's a lot of content that is already out there. There are a few blog writers who write very good stuff. There's one called Pecky McCormick who writes a very good newsletter called Not Boring. Right? Looks at from a very objective point of view. Very interesting new use cases. You'll definitely like that as well. And then there are these already existing. So if you actually take some time and you go to these exchanges that are out there, or say, for example, you go to Binance, you go to Coinbase, all of these have a huge amount of resources that are available, starting for very simple explanatory videos to the end of the concepts where you can explain a lot amount of this stuff. Correct? So all of these resources at the beginning will help you a lot. As far as experimentation and everything is concerned, there's a website called Rabbit Hole that will allow you to. What it does is it basically rewards you to learn more and more. So as and when you keep on learning and you experiment, you get more and more tokens. That's a very nice way of incentivizing you to start looking at the system, understanding it, and you get some benefits as well. So those will be the few areas you could start.
Yeah, I have I have some views here too. I think it's important to have to read about broad-based views of cryptocurrency, because 90% of the papers, blogs, articles that you read out there is written by people who are crypto enthusiasts. So they're heavily biased in every way possible. So I think if you're looking at learning something, make sure you have a biased view of the asset class. Because there will be people who are against and for it. Unfortunately, like the Google algorithm is such that I think it sort of promotes, or at least there's a lot more interaction happening with articles that are written by enthusiasts. So make sure you have a balanced view, and look out for people who also sort of have a balanced view and take a call accordingly. Because even all the white papers, all the research papers that you see floating around on the internet, most of them will be written by crypto enthusiasts. So I think just make sure that you know that when you're learning or you're reading something about this asset class overall.
Thanks, Pratik. Pratik, you tend to read a lot. So any books that you can recommend or suggest, which may not be directly related to crypto, but something maybe which our viewers can think about or consider reading before they even get into this?
No, I think one of the best in terms of books, there's this book called The Ascent of Money. It's by Niall Ferguson, I think. It's one of the best books I've read on the origins of money. Talks about money from I think how money originated, how the barter system started, to when it became gold and silver, and then how sort of wars were really helpful in building the entire sort of capitalist system where we are today. So I think it's a good way of it's a slightly complicated book, but it's a good way of understanding the origin of money, because Bitcoin is technically a new way of transacting. It's an alternative way of transacting. So I think understanding how currencies evolved over the last 2 centuries can really be helpful in understanding how this may or may not sort of go ahead and become one. Because because we are living in times where you expect things to be stable, but actually it's not. Anything can happen. The Russian ruble has fallen by 50%. Currencies in South America and certain parts of Africa have fallen. So I think you have to so I think if you're interested, a deep introspection or understanding of this entire evolution of money can be a good way of you to further your knowledge about these things.
Just to add one more point here. So for people, I would recommend the Ascent of Money to everyone who's out there, not only to understand Bitcoin and blockchain, to understand the entire concept of money and financial system. For those who don't get time to read, there's a very interesting movie that's out there called The Ascent of Money, a documentary that is out there on YouTube. It's a 6-part documentary. I would recommend everyone to go and watch it during your weekend or any free time that you have.
Awesome. Thanks a lot. Pratik, another question from one of our viewers, Rohit. Do you think blockchain can replace UPI that has already seen such wide scale acceptance in India? Do you think that could be an application that could be there in the future? And the government also talking about, a rupee based, RBI has been talking about some rupee based crypto or some sort of Bitcoin. What do you think is happening out there?
Yeah, I think so. I think the government is already talking about like a rupee, which is backed by the central government. So a trusted, at least trusted for the common man. So which will be built on, I'm guessing, on the blockchain network. So yes, I do think that could be an alternative currency. Just like UPI is again a form of payment. I think using the digital currency, which will be introduced maybe next year or the later, could be a replacement to that. It might be cheaper, it might be more efficient, it might also be a lot more transparent, and the government can also build contracts on top of it. So I think yes, I'm personally a lot more excited about blockchain as a technology than I am on cryptocurrency, because the benefits of that accrue to various industries, various sectors, various applications. So yes, I do think it can be made possible. It's also quite scalable. As Tushar said, I think we have to look at the environmental impact, and you have to have a system in place which makes it scalable as well as not very damaging to the environment. So if they're able to do that, I think it's great.
Tushar, anything on that?
Yeah, sure. So there's a lot of benefits. So as Pratik said, there are a lot of benefits of blockchain, correct? So any central agency or centralized company, in fact, can use blockchain, correct? Blockchain is different from crypto assets in way. Anyone can use a blockchain, but when a company uses blockchain, it's a private blockchain, it's a permissioned blockchain. Correct? That's the idea. So if RBI is setting up a blockchain, it will not be as transparent as everyone wants. It will be a centralized authority blockchain. It will be a permission blockchain, but RBI could use it. I think it will be very beneficial. They could, as I said, they will come with the programmable money concept. So they could give out direct benefits to people who are those in need. They could program the currency in very different ways. Correct? So those are all the benefits that each and every company will have. So you'll see Walmart is using blockchain. You'll see very different companies that are using blockchain. If you're looking at the other side, most of the blockchain which have a crypto asset, those are very different because those are decentralized blockchain which are public and permissionless. So in order to maintain that network and access that network, you need to have a crypto asset. Correct? So crypto asset enables that. So that will be two different ways. So a lot of people actually believe in the concept of blockchain. They can be applied, they will be applied, and almost all of the companies will probably see how they could incorporate blockchain into the use case. But the decentralization part is totally different from that.
Another viewer question, Pratik, this one's for you. You are the head of passive investing here at Motilal Oswal. So how does can you invest? Is there any way to passive invest in crypto? Abhinav is asking this and wants to know, how do you correlate passive investing to crypto?
I think so. Crypto is more of a comparison to stocks. I think there is a way to invest. You can create indexes out of different coins, which make it easier for you to invest in crypto. So suppose you're creating an index, a passive index, which, if you're putting in 100 rupees, it invests 10 rupees in the top 10 currencies. That could be a good way of investing, because then you are taking out some of the individual downsides. Suppose one or two go down, the rest are there for your investments to at least stay sort of stable. So I think yes, there is there are a lot of platforms out there, not in India but at least abroad, which give you the option of buying these indexes or these baskets of crypto, which really take out some currency level risk out of your investing. So so I think that can be a good way. I mean, in India, I think in terms of offering this as a mutual fund, I think that's not going to happen. I don't think it's going to happen anytime soon, because it's just not a regulated product. But I think people can, number one, buy baskets from, I think if you have a wallet, and if it's transferable, then you can obviously go out there and buy these baskets. What you could also do is invest monthly, or something called SIP in crypto, because then you're negating a lot of volatility that's happening in cryptocurrency. So that's also a good way of investing. So invest baskets and invest in every month, so you don't have to deal with the day-to-day volatility that happens. So that's a safe, not a safe way, but a less sort of risky way of at least investing when it comes to in cryptocurrency.
Rishit, any apps providing crypto baskets that I can look at?
So you can look at a lot of decentralized apps will give you. On a decentralized platform, there's this website or this decentralized protocol called IndexCoop. They offer two baskets. As I said, there are three use cases, correct? So one of those was D5, that is a decentralized finance, and one was Web3 or the metaverse. IndexCoop offers indexes on both of those. So you don't have to worry about the rebalancing. You don't have to worry about the positioning and everything. They have an index for both the D5 application and one for the metaverse applications. So you can get access. You can easily, it's just a one-click transaction. You can get invest in those indexes.
So hopefully it's a invest and forget, like how we do with SIPs and mutual funds, right?
Yeah,
last question, guys, for the evening. We talk a lot about, we've heard a lot about, crypto exchanges being hacked, or a lot of fraud that happens in crypto. This is for both of you, what are one or two things that investors and our viewers can do to kind of safeguard themselves from, falling prey to some of these hacks or these frauds that are happening out there? What are some obvious frauds that, people should just kind of stay away from?
So I'll take that first. The first thing that Pratik already mentioned, correct? If you're getting into this field or dabbling into this world, make sure that you are only putting money that you are okay to lose with, correct? So that's the number one point. So as we have a core plus satellite approach of investing, correct? With the crypto assets being added, I call it the core plus satellite plus explore portion. So use that explore portion. Explore.
Oh, I thought explore. Diwali firecrackers. Okay.
Yeah. So you can explore with these. Research the tokens that you're getting into. So Bitcoin, Ether, these are all very well-known tokens. There are a lot of these tokens that are out there, which are basically smart contracts, which basically take away your money and run with them. Correct. So when you're investing in any particular token, if you just Google it, if you use Twitter, I think Twitter is one of the best places where you can get access. There are a lot of these people who actually go through the smart contracts and can provide you services. Correct? So they will tell you whether these are scams or not. And most of the scams are already out there. Correct? So if someone is getting there, already there's people putting stuff on the information that the smart contracts are not looking good. So these can be those who could basically run away with your money. When you're investing in, say, for something like NFTs, join their Discord groups. Look at the community that is there, talk to people. I think it's a very welcoming community. There's so much information on Twitter, on Discord groups that you can easily get to know with all of, get to talk with a lot of people, get to research a lot. But for most people, correct, who are just looking at it from an investment point of view, invest in tokens which everyone already knows, correct, which are already out there. If you're investing through a exchange, centralized exchange, make sure that the privacy of that network of security is good. Correct? There are a lot of these exchanges that are there in India, which are backed by international exchanges. That security is very good. Or if you're very worried, store them in a hot wallet or a cold storage wallet. Hot wallet again can be dangerous. Better if you could put in a cold wallet. So these are some of the basic key steps that you could have and ensure that you are safeguarding your investments from all of these hacks. And never, just a final point, never ever ever give your cryptographic keys to anyone. Correct? You basically, if you're going to give it to anyone, it is your assets are going to get wiped out in a minute. Not give it to anyone. Don't store it anywhere. Correct? If you're storing it on Google Cloud, if you're storing it on a note-taking app which is backed on some cloud, there are hackers, there are people out there who are scraping all of those codes on a continuous basis. Right? So they'll be looking out for these keys, and one day you'll wake up and all of your money would be gone. So please make sure you put it down on a piece of paper, you put it down somewhere, you store it in your mind, whatever you want to do, but don't put it there on any electronic format which can easily be hacked away. That's the idea.
Okay. Pratik?
Yeah, I think, yeah, so to end, I think, as Tushar, again, I'm going to say the same thing, but, I think look out, there are countless and countless of scams happening on a daily basis. I think partly it's because there's not a lot of regulation around crypto. And obviously it's also a medium where it's very hard to trace people. They could be in any country, any city. So I think it's outside your jurisdiction also. So even if something happens to you, you won't be able to do much about it, which is a big problem. So I think crime is a big problem. And I would say, whenever you're transacting or looking to transact, make sure you're transacting with a trusted exchange, or use a wallet, or use something which has been used by a lot of people. Talk to experts. As Tushar said, you can look at the Twitter community. There's also a huge sort of bot sort of problem in Twitter right now, but I think apart from that, there are a lot of credible guys with good advice out there. And lastly, I think be very don't be swayed by promises that a lot of these apps give you about 20%, 25%, 30%, 50% returns. I think a lot of this is very risky, and there's a good chance that you will lose your money. So I think just have your expectations matched. Use credible platforms. Use Twitter to figure out what to do. And also, as I said, you should be extremely careful about how much money and where you put your money when it comes to these sort of asset classes.
All right. So with that, we will end our session today. Thank you both, Pratik and Tushar, for firstly taking out the time for this and giving your sharing your valuable knowledge that you have on this topic. We hope to be able to do more such sessions with you, and also bring other crypto experts onto our webinar. So just a few takeaway notes that I would have, right, for all our viewers. There is this space has exploded, right? So there are lots of terminology, lots of things to learn, but a lot of information available. I think there's also an information overload at some point. So be careful of what you read, where you read, and how you read it. But start experimenting, start learning a little bit, and maybe you can do it just for the kick, just for having fun, or just being, or so that your FOMO doesn't get, you don't have FOMO out of it. So be safe, be secure, and thank you once again for joining us today. Thank you, guys.
Thank you, everyone.
Thank you.